This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome to the Money Seed Podcast. He's Chris Ferguson. I'm Gabriel Stvore. And today we are talking about retirement. Chris, what do you got for us?
Well, before we jump into retirement, let's do our famous quote of the day or discuss famous investors. So I will start with a quote from Ray Dalio. School typically does not prepare young people for real life unless their lives are spent following instructions and pleasing others. In my opinion, Ray Dalio's opinion, that's why so many students who succeed in school fail in life. I, as a doctor, have spent a lot of time in school, and I will agree with him. School, for those who are not aware, school was designed to prepare people to work in factories or work for companies. That's the purpose of school. You're given information. Your goal is to accept the information, or at least assimilate the information, and then put it back on a test. And some would argue that you have to figure things out in subjects like math, et cetera. But really, you're still given a set of protocols that you memorize, and then you put it on a piece of paper or on a computer sheet, and then you hand it in, and that's school. School does not allow for individual thought because you're given grades based on your ability to reproduce what you've been taught. It also doesn't really facilitate working with others. I have a lot of criticisms about school, but really school is really meant, and it works really well for some people, and it works really well depending on what your goal is. If your goal is to get a job and work in some sort of pre-existing structure, I think it's great. If you want to deviate from that, probably not so great. What are your thoughts?
Yeah, Chris, I agree 100%. This reminds me of the conversation we had in episode 1 about worker bees, right? Same idea, right? So talking about retirement, what did you learn in school about retirement?
Nothing. School teaches you nothing about retirement. School teaches you nothing about finance. There are accounting classes which teach you how to use a spreadsheet, but they don't get in. I've never learned anything in any class about retirement.
Thank you. Exactly. I fully agree. It's one of the most important things that people have to plan for, that people have to keep in mind, that people have to take care of is their finances during retirement. And our education system teaches us zero, zilch, nada, nothing about retirement. It blows my mind.
It is interesting because I took an entire class on anatomy, and I spent a lot of time learning about cat anatomy, and we had to label these parts on a cat. And that's not really useful. I remember basic science classes learning a lot about flowers and the names of flowers and the names of assorted things. Not really useful. It's right, interesting trivia. That's about it.
Totally. Yeah. So, retirement, we can talk for a long time about retirement, but let's keep things simple. Have you gone on the Social Security Administration website to check your estimated monthly Social Security benefit when you retire?
I have not.
As of 5 hours ago, neither did I. So I knew that today we were going to talk about retirement, and so I did some rudimentary research on the internet. And one of the things everybody in America can do, if you have a Social Security number, which I imagine most people in America do, is go on the Social Security Administration website, ssa.gov, and there you can create an account. So there's an account already created for everyone, and you can go in there and you can actually see the record the Social Security Administration has on you, and you can put in, say, okay, look, if I maintain this certain level of income for the next 10, 20 years, then on this day, if I choose to retire at age 62 or 65 or 67, whatever X number of years from now, what my estimated monthly Social Security income will be, which is super useful, right? Because a lot of people, sadly, they overestimate. They just have this number in their head. They think, oh yeah, the government's going to take care of me. I'll be in great shape. The government, will not let me down. And a lot of people are often surprised that their Social Security check is smaller than they imagined. And by that time, it's too late. If you're 63, 4, or 5, and you're like, oh my God, this check is smaller than I thought. You really should have checked that earlier, right? This is important stuff.
So what did you find?
Yeah. So basically, the average Social Security check in America right now is just over $1,500 a month. That's the average right now. It can go as high as like 3,700, right? For somebody who delays until the maximum. So if somebody waits until age 70, which is the last possible day that you can claim that Social Security benefit, and you had your 35 years of work in America where you worked and paid taxes and you had a pretty good income that whole time, et cetera, then you get the maximum, which is like 3,800 a month, which is really good. But a lot of people make a lot less than that, et cetera, in Social Security. And so the average Social Security check in America is $1,500.
Well, and I think some people will think that's pretty good. And a lot of people will think that is not good, depending on your current status of income.
Well, if you look at it this way, I mean, let's make the numbers easy. Let's say it's $1,600. If you divide that by 4 weeks, that's $400 a week. Divided by 40 hours, that's like $10 an hour, really. Then that's less than minimum wage in many states, right? I mean, people right now are talking about a $15 minimum wage. So most people in retirement, the average American retiree is getting less than minimum wage, the equivalent of less than minimum wage when they're retired.
Well, then they're also not working. So if they really want to, then they could get a job working somewhere, doing something, making theoretically minimum wage. So then they're making not minimum wage, they're making $20 an hour.
Correct. And look, if you have two people who are sharing a household, right, a retiree couple, and they're both getting a $1,500 Social Security check, that's $3,000 a month now. They might be okay if they really cut their expenses and maybe they have already paid off their house. They might be doing okay on that kind of money. But you're right. There's always that option if someone's healthy to take on a part-time job and maybe supplement that income if they need it. But I think what this podcast is about is to encourage people to get ahead of that by 10 or 20 or 30 years. So you don't have to be forced to work if you don't want to at age 70.
You have a phenomenal point. If you can do that, because when you're 50, 60, 70, that's when health conditions start coming in. That's when, say, your knees give out or your hip goes out, et cetera. So while you can do that when you're in your 20s, 30s, 40s, 50s, and then you may not physically be able to work those hours. So while you may need to, you may not be able to.
Right.
So you did some fantastic calculations on what you need to retire. What did you come up with?
Yeah. So, I mean, let's go through the numbers. So this is a very simple, very simplified high-level calculation. So let me just share my screen here just to kind of run through what this kind of looks like. All right. And there's the title. It's a very rough retirement calculator. And so let's say you figured out, and this is different for every single person in every couple, whatever, depending on where you live in the country, et cetera, how much money you want per year in retirement, right? So let's keep the numbers super simple. Let's say you want $100,000 a year, right? When you retire. Now, to a lot of people, that might be a lot of money, not a lot of money. It's just a number. Okay. This is not a judgment on what you should have or shouldn't have. This is just a number to show how the calculations work. Some people might be very happy with half that amount. Some people might want twice that amount because they want to have a second home in Florida and they want to go to Hawaii with their grandkids, whatever, right? I mean, this is just a number.
And I'm going to emphasize that this is pre-tax.
Correct. And thank you for pointing out, this is pre-tax, right? So yeah, you want 100,000 a year, right? Per year, but you know that there's Social Security helping you out. And just to keep the numbers consistent from our previous example, let's say a couple are both getting $1,500 a month. That's about $3,000 for the household times 12 months. Let's make the numbers nice and round. Let's say that's $40,000 a year. Okay. We're rounding up to keep it simple. So therefore they would need to supplement the difference, right? They would need to supplement the $60,000 difference. So something else, right? Other than Social Security, they would need another $60,000. So the question is, okay, so we're all saving money, right? Like People are putting money in their 401ks. People are putting money in their stock portfolios. People are getting their second homes for income, like income properties. Some people are buying Bitcoin, whatever. Let's say you want another $60,000 a year from somewhere. So all you got to do is take this number, 60,000, and multiply it by 25. So where's this magic number 25 come from? It comes from the idea that if you have a portfolio, you can take out 4% of that portfolio every year for a very long time, right? If your portfolio is gaining 4%, 5% a year in just that's what the investment is returning, then in theory, you could take out $60,000 a year forever.
That's a big assumption, though. That is a big assumption.
It's a big assumption, right?
That's a big assumption.
It's a big assumption. But then again, we don't live forever, right? So even if you have a bad year, okay, so let's talk about that. Really, if you retire at age 65, I just looked this up earlier today. In America now, if you are 65 years old today, your life expectancy is roughly 20 more years. It's about 18 more years for men, 22 years for women, right? That's if you're 65 years old, you can expect to live another 20 years. So really, even if you have a couple of bad days a couple of bad years in your portfolio, and the stock market, has a bit of a drop, and maybe 1 year you want to help your grandkids go through college, or and maybe you take out more than 4% or whatever. That's fine, because you're actually on this burn down path to kind of use up your nest egg by in that 20 years, right? So you should be able to take out 60,000 for a very long time, more than 20 years, but there's a bit of safety of margin in there. Okay. So 60,000 times 25 gives you a number, I believe it's 1.5 million.
Wait, I missed it. Where'd you get the 25 from?
So the 25 is the opposite of 4%, right? So if I have a $1.5 million portfolio and I take out 4% every year, 4% of that is 60,000.
Okay.
Right. So basically, if you have 1.5 million across a wide range of investments, that's everything, including 401k and other stocks and income properties, whatever, then you take out 4% a year. That's 4% of that is 60,000. And you should be able to take out 4%, you take out the 60,000. And you know what? Throughout that year, that 1.5 million should recover, or at least maybe recover somewhat. So you should never run out of that money, right? Even if you live more than 20 years, you'll be fine. And if you live less, well, then your kids will just get a bigger, a bigger inheritance. But the 4% is a quite frequently used numbers that financial planners will tell you, right? That they'll say, yeah, 4% a year is what you should count on. And it's interesting to note here that net worth, right? The net worth also includes the house you live in, right? Because if you have paid off your house, whether it's fully paid off or half paid off, that is net worth. That's value you have, right? If it's fully paid off, well, that's good, because now you don't have to pay rent every month. Or what some people do is they sell their house to get their net worth out of their house, and then they go rent somewhere else. But your net worth also includes the house you live in, which is important because that is a big chunk of the wealth that American families have, is tied up in the real estate of the home they live in. So 1.5 million. So if somebody is 65 years old right now and they have a $1.5 million net worth and they get the average Social Security benefit, then they could expect to enjoy a very comfortable retirement with a pre-tax income of $100,000 per year.
So there are a lot of investing strategies for retirement. Some people will, I would, based on conversations and reading prevailing financial advice, the standard advice that I have heard is you max out your 401k plan and your whatever, a lot of investing plans, and you just max that out as much as you can, and that's it. And pay off your debts. That is the strategy.
And that's not a bad strategy. Look, I believe that if people are fortunate enough to work for a company that has a 401k plan, right? Like some kind of a matching benefit for 401k. A lot of companies have a plan where an employee puts in, let's say, $1,000, the company will match like 200 or 500 or something. That is amazing. I mean, that is like an instant guaranteed return on the money you invest in that plan. Do it. I always say, if you have a good company and that 401k match is there, do it, take advantage of it, put the money there. If you're going to do 401k, you really can't touch that money before you are like 59 and a half years old, right?
Well, you pay tax penalties.
Correct. That is correct. So yeah, you can touch it. It's your money, but you will be hit with a tax penalty. You're strongly incentivized not to touch it before you're 59 and a half. So I would say put some money in your 401k, take advantage of that employee match. And on the other hand, you'll have some other investments that you have on the side that you can access anytime without any penalties that you don't want to deal with. Have both.
So here's an interesting thing. So you have to pay a 10% early withdrawal fee plus the normal income tax you pay. So it's 10%. Now, I'm not advising anyone to do this. However, I had a 401k plan when I first started working. It was a very small 401k plan, a relatively small 401k plan. But I cashed in my 401k plan because I needed money for an investment. So I paid the 10% early withdrawal fee and income tax. Then I bought my first investment property, and I am doing dramatically more than 10% in returns per year. So I arbitraged, or I can never say that word. Arbitraged the penalty for early withdrawal because it cost me 10% plus the income tax for the early withdrawal. However, the return I got on that property far exceeded it. So I still came out ahead. Again, this is not like a standard investment strategy. It's not something I do all the time, but it was an investment in a property that was only available in this little window. And that's where I got the money.
Amazing.
So while there are general rules, I think by understanding the rules and when they work and don't work, that's how you get ahead. Because I told people, financial planners, advisors, etc., this is what I'm going to do. And they said, no, don't do that because obviously you're paying the larger penalty. However, when I talked to my really astute accountant and he did the math for me, he said, no, this makes total sense. Cash it in.
Amazing.
And I've done really well with it.
Amazing. That's really cool because you're right. I think most financial planners would have told you not to touch your 401k, right? And when they give you that advice, I think it's standard advice they give anybody because they're trying to protect you from making a mistake, or they're trying to protect you from squandering your money away. They're trying to protect your downside, right? They're not looking at, hey, look, this could be a really good investment. Yeah, exactly.
Well, I think it's important to know what your strengths are. So like, how good are you investing? Like with all things, some people are better at investing and some people are they have the emotional stability to invest and others just don't. Some people have the physical stature to be a defensive lineman and some people just don't. If I were a defensive lineman, I would get squished like a bug. That's not how I'm made. But I can look at it objectively and say, this was a good call, even though a lot of people told me it was not a good idea. But I just objectively ran the numbers and then it made sense. So I did it and it worked out well. Again, this is what I did. And I'm not telling anyone else to do this, but this is what I did. And it worked out well for me in this case. Well done. Well done. It was, if you want more details, it was a foreclosed house that, here are the actual numbers. So I bought the house. The house was, you're better at the numbers than I am. So if you want to run the numbers, feel free. But so I purchased the house. It was worth $170,000 as a short sale. I put $40,000 down about let's say 10 years ago at this point. The house is now worth probably about $310,000, and it's renting for $1,700 a month. Amazing. So you went from $170,000 to $310,000. So that's $140,000 of equity that you've gained. But but that's off $40,000. And you only paid $40,000 for that, and you're generating a monthly income from it. Yeah. Yes. That's amazing. So, wow. I don't know exactly what the return is, but it's very good. Yeah, I'm not gonna. It's very good. Start crunching numbers now, but I can tell you, but it's very good. The gist is, it's exceptionally good.
That's incredible. That really
And if
is.
I could, and I'll be
Yeah.
the first to say it, I can't replicate that with every investment I make. However, at that time, I knew it was the right call.
Yeah.
So with all of these general rules, I think it's important to know that there's exceptions to it. And some people, I will tell you, they consistently make really bad investment calls, and they should then these strategies should not apply to them.
Right. Right. I think the overriding advice you will get from financial planners is still, for the average person, you go to a financial planner, they're gonna give you advice that will say, play it safe, save a little bit every month, pay off your credit cards, like do the Dave Ramsey method, which I think works for a lot of people. Pay down your credit cards, live beneath your means, save a few $100s a month if you can, save more if you can, put it somewhere safe, 401k, mutual fund, etc. And I think that works okay for many people, right? That's, you can't really fail if you follow that formula.
But it depends on the results you want. So if you want to amass a really healthy retirement, it's an okay strategy, but it's not, I think, an aggressive strategy that can get you where you want to get to. But you have to know whether you have the temperament to do that or not. And of course, saving and all those things go without saying, but it's hard to really make money if all you're doing is being paid per hour or on a straight salary.
Mm-hmm.
Unless you have one of those jobs that just pay exceptionally well, and then it works.
Yep.
But then I would argue if you have a lot of disposable income, then why not be more aggressive with your investments?
Absolutely. I agree with you fully. So, talking about it on a personal level, we talked about that 1.5 million number theoretical calculation at age 65, $100,000 a year income in retirement, etc. Personally, I really don't want to work full time until I'm 65. So I think I have an opportunity to retire well before then. And, the way that number, the calculation changes only slightly is that if I want to, let's say I want to retire 10 years before 65, right? Let's say I want to retire at age 55. Well, then I just need to wait 10 years or maybe even like 15 years before I start collecting my Social Security benefit, right? So then same calculation. If you want $100,000 a year multiplied by 25, you need $2.5 million. So if I have a $2.5 million nest egg, I can comfortably take out $100,000 a year. And then 10, 15 years down the road, when Social Security kicks in, it's like a bonus, even better. But yeah, really, if I have $2.5, $3 million of a net worth, that's enough for me to start thinking, do I really need to go to work tomorrow? Or do I want to go to work tomorrow? Maybe it's a better question. Like that's kind of like my magic number, right? Is about 2.5, 3.
So here's an interesting thing: is the financial planners tell you what they know. So they went to school to be financial planners, and they make money being paid by these financial planning instruments to have you put the money in there. So they're actually not making money on stock investing. They're making money on selling you stock, which is an entirely different thing than being good at stock investing. Like, one is a sales job and one is actually an investing job.
I agree. And I think the entire financial industry is broken. So there are two types of financial advisors. And let's talk about the first one, which is the one you mentioned. Mm-hmm. The first type of financial advisor is usually the one that works at your local bank, and they're very friendly and they're nice and they're polite. But all they do is, like I say, it's a sales job. They just sell you whatever mutual fund gives them and the bank the biggest commission for the sale. They don't really know or care what they're selling you. It's somebody else's product, right? They just sell you a mutual fund. They get a kickback for every, I don't know, they might get like $500 for every like $5,000 worth of mutual funds they sell or whatever it is. They get it. That's how they pay the bills. That's how the bank gets the money. It's a sales job. And they don't know or care what they're selling. To them, it's like somebody selling a car at a car dealership. They want to sell the car, they'll get their commission, they're done. Mm-hmm. I really, and I hope I don't offend anybody, I try to avoid that type of financial advisor. I think the first question you got to ask a financial advisor is, how are you compensated? And if they say, oh, don't worry, Chris, this is free, this will cost you nothing. That's a load of crap. Nothing's free.
Nothing's free.
Nothing's free. Because usually a mutual fund company will give them a kickback for selling whatever they want them to sell that month. The financial advisors I like are the ones that charge you by the hour, who will say, Chris, I will sit down with you for an hour. We'll review your numbers, your investments, your plans. I'll give you my advice and I'll charge you what $100 an hour is my fee, because then they're not incentivized to sell you anything. They're not selling you anything. The only incentive they have at that point is to give you good advice so that you give them a good feedback or rating on Yelp or Facebook, and they have more customers. Because at that point, you are the person giving them money. You are the person that's gonna get the benefit of that person's time, right? And so if you're gonna go see a financial advisor, talk to somebody who charges by the hour, and that's their only source of income.
100% agree. 100%. Part of what I do to figure out what my long-term strategy is I will talk to people who are where I want to be. And I'll just ask them, like, what did you do? And people are shockingly really open about saying, this is how I invested. And I think it's important to talk to people who've done really well and people who have not done well, because there seem to be common themes amongst people who do really well and people who do not really do really well. And even if you don't have access to people to ask them directly, you can always just read a book about them. And I think that's why it's great that we're profiling phenomenal investors at the beginning of every podcast, is because we're looking to these people who are financially exceptionally well off, and then we follow their footsteps. So that's the interesting thing about trying to figure out what is the best strategy. So as I said, I talked to a lot of people and tried to figure it out. And you can have a job and you can get, let's just say for the sake of hypothetical argument, you have a really good paying job. You should, if you're following conservative Dave Ramsey type economics, you don't go crazy on your car. I think cars are a horrible investment. They're not an investment. They just lose money. They lose money and they burn money. As a quick aside, so I bought a 2010 RAV4 in 2010. And it has held its sticker value phenomenally well over 10 years. I have 134 miles on it, and I think I could trade it in for about half the price that I bought it for, or maybe a little bit less. I got the base model. It's running great. I fully intend to run this, use this car for a lot more years. And there's some talk about me trading in the car for another car, but why? Like, I just don't like buying depreciating assets, and that's what a car is. I think it's interesting that people will spend a lot of money on a car, and the second they drive it off the car lot, it's just, you're just burning money, not just in gas, but just in depreciation of that car. But they're very hesitant to invest in real estate or the stock market or a business, which could potentially yield phenomenal returns. It's just a funny way to think about it.
I agree with you completely. I mean, the fact that you have a car right now that's fully paid off means you don't have to make a $500 car payment every month. So for every single month that you're driving that car, that frees up $500 in your budget to invest somewhere else, right? Mm-hmm. Whether it's cryptocurrency, stocks, mutual, wherever you want to invest, rental property, wherever you want to invest, that's $500 a month you have right now, because you are not driving a nice, shiny, fancy, brand new car, right? And
that is exactly how I think about it. I don't think of it like, now I have $500 to blow on like $5 lattes every day. I will tell you, I know of people who buy $5 lattes every day, and it adds up really fast. Or you go and you eat out often, and it adds up really, really fast into a very sizable amount of money that you could be putting. You could have that money working for you in whatever investment vehicle you like. And even if it doesn't work out and you lose all the money, I'd rather take that risk and invest it than just eat it or squander it. So in looking at people in my social circle and people that know people and in reading books, it seems like a really good approach is, however you get your base chunk of money, you take that money and then you invest it in other things. And if you are good at investing, you can grow that really, really quickly.
I agree. And like we talked about in previous episodes,
yes,
start early, right? The earlier you start, time is on your side. Time is your number one friend in this game. And yeah,
and if you start, Yeah, and if you start early, and even if you take a calculated risk, even if you invest in a business and the business goes belly up, you still have time to leverage what you've learned, not make the same mistakes, and try another business, and eventually one will hit. And I know this is a retirement podcast, but as an aside, there was this website called Upwork. I don't know if you're familiar with it. It's where I'm pretty sure it was called Upwork. It was where you could you can say, well, I have this skill, and someone could hire you online to just do this skill. And the way that started was there was this guy who started. He was initially started some sort of engineering firm, and he was just literally bleeding to make this company work. Like he was working there 24 hours a day, and it just wasn't working. And then he talks about how it just kind of crushed him because no matter what he did, he just couldn't get it to work, so it failed. And then he had to make money because he had no money because it all went away with the business. So then he got a job just doing spreadsheets for someone. But then he realized that, well, he could just hire someone else to do the spreadsheets. And then I can never say this word, arbitrage that difference and then keep the money. And then he just created but he had to keep looking for these people to make these Excel spreadsheets. So then he created a website that would facilitate someone just bidding on that job and then taking the job, and then he just expanded it, and then it was worth some ridiculous amount of money. So he doesn't really have to invest really well because he has had this website. I'm sure he sold it or whatever he did with it, and now he has a big chunk of money and doesn't have to do anything. Mm-hmm. But it's that mentality of being willing to take calculated risks, I think, is what is one of the main underlying themes of people who do well. So this leads me into another question about retirement. And I'm curious what your take is, and I have a different take than a lot of people, but we'll see. We can discuss this. Let's say there are three different scenarios. You get to the age of, let's say, just say 65. You get to 65, and the three scenarios are, let's say you have enough money that you could just live off your savings. You don't have to invest it. You don't have to do anything. You just live off the savings. What would you do? Would you invest, not invest? Would you just live off your savings? What would you do in that scenario? The second scenario is, what if you're in that middle ground of you have enough, you're relatively comfortable, you could be more comfortable, but you're fairly good. What do you do? And what if the third scenario is you really haven't planned out your retirement well, and you probably are going to have to work into your retirement, and you have a little nest egg, but you clearly cannot retire on this, and you're going to have to work into your 60s and 70s, 80s until you can't work anymore. Mm-hmm. How would you approach those three scenarios?
I think I'll start with the last one because I think that's the easiest one to address, right? Is if
yes,
I don't have enough money, like really don't have enough money, then there's really only two choices. Either accept a poverty-like existence, mm-hmm. or have hope that I have the health and the strength to work 10, 20 hours a week somewhere and make some money to supplement whatever income I have. I don't think either of those two situations is ideal, right? And so that is the situation I'm trying to avoid, right?
Well, there are a lot of people who are there. And let's say you have, let's say you have somewhere between, let's say you have $30,000. You have $30,000 from a 401k plan that you've managed to get over the course of your life. What would you do with this? Because the reason I ask is conventional wisdom is you're towards the end of your life. You should take very safe investment risks at that point, maybe some bonds, mutual funds, etc., and just be very, very safe with it. Because a lot of investors will say, as you get towards your 50s and 60s, you're going to move off those high growth funds into really, really safe things like a bond, whatever, and give, so you can get like 5%, 4%, whatever it is. Mm-hmm. Would you follow that advice, or would you do something different?
I think that's a more relevant question for the first two scenarios you outlined, because I think the last scenario you outlined is a very desperate one, right? Mm-hmm. I'm 72. I don't have enough money. I need to supplement my income. I only have 30,000 in my 401k. At that point, I mean, desperation always leads to strange decisions and strange outcomes. And I don't know what I would do, because at that point, I don't think I would have the luxury to just sit there and think about it all day. I would probably have to yeah, look, if people are desperate, they're going to do things that people who are not desperate are not going to do. And so I'm not sure what I would do in that situation. And, for the record, like my father is in his 70s and he still works part-time because financially he's unable to retire. And so he needs to supplement his income. And it's a tough road. It's a tough situation to be in. And I don't know what I would do. But getting back to the first two. So let's say the first scenario you outlined, Chris, what was it
The
again?
first one was someone, you have several $1 million in the bank, way more than you could ever spend.
Right.
You're very, very comfortable. To me, that's the easiest one.
That's the easiest one. Okay.
You do.
Right.
I would say you do nothing. I would do nothing. I would say I have my money. I wouldn't even put it in. I would just sit on it like an egg and do nothing with it. And when I need it, I would take it out of my bank account. I wouldn't risk a penny.
Yeah, exactly.
I have what I need.
Yeah. And just to say the obvious things, you don't want to put it in one bank account because I think the government only insures like 400,000 or like $500,000. There's a limit to how much the federal, like the FDIC insures as a bank deposit. Like if the bank goes under, you're only going to get whatever the
that's
minimum.
Interesting. I didn't know that.
Oh yeah. Let's say if you have $2 million in one bank account and that bank goes bankrupt, the federal government is only going to reimburse you like whatever $500,000. There's a maximum limit that the FDIC will reimburse customers for.
Do you know what it is?
I don't know what it is. You can look it up quickly. FDIC insurance limit or whatever. It's something like $500,000. I'm give or take. I'm guessing.
The standard deposit insurance coverage is limited to $250,000 per depositor.
Wow. Okay, less than I thought. There you go. Okay.
So I get it. Now, some people will be thrilled to have a fraction of that in a bank account. However, if you're towards the end of your working life, you probably need more than $250,000 to retire.
Absolutely. So first of all, so
this is an important thing to know.
Yeah. So that's just another reason why you don't want to have a lot of cash in your bank account. And never mind the fact that cash in a bank account, like you said this yourself, I think a few times, like the worst place you can have your wealth is just in cash, because basically you're going to get next to zero return on your savings account and inflation eats away at it every year. So no, I would say never put more than 10% of your wealth in any one stock or asset. So if you have gold in your portfolio, don't have more than 10% of your wealth in gold, don't have more than 10% of your wealth in Bitcoin, don't have more than 10% of your wealth in like Tesla stock or Facebook stock or whatever it is, right? Just kind of spread it out a little bit. But I would most likely have it spread out between value stocks, like good, well-established companies. I would say maybe 10 or 15 companies at the most. I don't think diversification doesn't really make sense past like 10 or let's say like 10 different stocks or whatever. So I would pick 10 stocks, most of them if I'm getting ready to retire, I would look for solid blue chip companies with a good track record, big balance sheets. And I would probably start looking at ones that have a good dividend yield, right? Because right now I don't have any stocks that have a dividend, because right now I'm not looking for dividend, I'm looking for growth. But if I get older, I would probably start picking dividend stocks, which is similar to what you said about the bonds. Technically, they're safer. These are companies that are already mature companies. They're not as risky, and they are actually paying you a dividend every year. And that dividend yield could be 3, 4, 5% usually is what the better dividend yield paying stocks will pay. So if you own $100,000 of a dividend yielding stock, they might pay you $3 or $4 or $5,000 cash every year, right? So that's what you're kind of looking for in your retirement. Is looking for income anyway. So that's a good way to go. But I would have a little bit in gold, a little bit in some other asset like Bitcoin. I'd probably keep one or two of my investment properties, and then have the rest in, say, 10 different stocks. And most of those stocks, or at least half those stocks, would be dividend paying stocks.
I think people vastly underestimate real estate as an investment portfolio for the future. Now, it is more work than just sticking your money in a 401k plan. However, I personally know of people who have done very, very well with that, with their retirement. On the Get Healthy 360 podcast, I interviewed Corey Fawcett. He's a physician. He never made more than $200,000 a year over his entire life. That was the most he's ever made in a given year. But he took that money and purchased 4 apartment complexes, and didn't take any of the money out. Any profits he made from those apartment complexes, he just put it back into paying off the loans. And that's it. He didn't do any crazy financing. He didn't get investors. He did nothing else other than purchase those apartment complexes. And he's making more now, retired, off the rent. He is managing them himself. However, I'm sure he could easily afford a property manager if he so chose, but he manages it himself. And he's making more now than he ever did as a surgeon. And that was discussed in the podcast. I know of family members who very, very early on, they scraped money together, bought an apartment complex, and again, didn't pull any money out and just let it ride over the course of 20, 30 years. Once it pays off, it just throws off cash and they don't do anything with it. It just sits there and it's an amazing dividend. So the real estate has appreciated with time because they bought in good areas. It pays rent and you have certain tax benefits, etc.
That's right. And as I recall, you interviewed that gentleman, that doctor, on the Get Healthy 360 podcast. And it's interesting that you mentioned that, because I just realized that I recall in that interview when he talked about buying that first apartment complex, right? It was like a fourplex or an eightplex or something similar. I think it was an eightplex. And he bought it from somebody who was retiring. And the way he was able to buy it is he didn't need to finance it through the bank. He financed it through the seller. So he signed a contract with the seller that said, okay, I will pay you like $20,000 or $30,000 a year, right, for the next, whatever, 20 some odd years, because that's what the person retiring wanted. The person who was retiring wanted that cash flow every year. And so that's
exactly. He didn't want the big lump payment because then he'd actually be paying a lot more tax on it. And this would be a nice dividend over however long. And then he didn't have to deal with managing the property.
Yeah, exactly. So the retiree got what he wanted. He wanted stress-free cash flow. And as an investment, you know, the doctor, he got what he wanted, which was he didn't have to finance it through the bank. He was able to self-finance through the seller. So
he bought that with no money down.
Yep. That was a great story. That's right.
And I think that's why that speaks to the value of networking. And if you're going to retire, it's worth talking to people to see what they've done and reading about it and listening to podcasts and watching YouTube videos. So the first scenario is really straightforward. So you have a lot of money, be conservative. Like, you have what you want, risk nothing. Now, the middle ground is a little bit more iffy. What are your thoughts on that middle ground, where you have enough money, you can retire, but it's just not a comfortable retirement?
If I find myself in that situation, the best way I can help myself is to minimize my monthly costs, which means I would most likely move to a small town where rent or property is very cheap, so that my monthly rent or like monthly whatever, like I can buy a house for a very low cost, whatever. So my monthly costs, right, in housing costs and food and whatever, just try to minimize my costs, right? Because that's, once you're on a fixed income or you have a limit as to how much you can make in a month or in a year, then the best way you can help yourself is to minimize your expenses. And yeah, you know what? I would cut down on travel. I would cut down on my luxuries. I would maybe ride the bicycle more and drive less, or maybe I wouldn't even get a car or whatever. And I would just try to figure out a way to live within my means.
Well, if you live somewhere where it doesn't snow necessarily, or the snow isn't heavy, or just somewhere reasonable with weather, it would be healthy to be able to just ride the store, pick up your groceries. That's your exercise for the day. It's a cheap way to get exercise. You can either rent, or if you downsize your house from wherever it is you're living, say you're living in like New York or San Francisco or some very expensive place, you downsize to somewhere south where it's warm, much smaller house, much more affordable cost of living. Maybe take up fishing or hunting or something and get food that way, which is also a healthy way to do it. Go learn how to forage and eat wild mushrooms and whatever. I agree with you. Cut your expenses, and that's a very viable way to do it.
Like you said earlier, no $5 lattes. I'm gonna brew my own coffee every morning. Yeah,
no. Every $5 latte is $5 you can't invest. Like, that's not working for you. I know a lot of people buy $5 lattes and then they complain they have no money. So
totally.
But I think we have a slightly different strategy with the, if I think if you're desperate, that's when you take, like, if you don't have a lot to lose, that's when you take large risks. And then that's what I would, if I somehow ended up in that situation where I really didn't have a lot of money, I would go for really aggressive, but like stocks that I thought were like fairly straightforward. But by the nature of how I function, like, so I'm a physician and my specialty is pain management. So I've focused onto a very specific set of skills to treat a very specific thing. But I do well in that narrow scope. So I know that the theory is don't have more than 10% of your stock in any one stock, but given the time that I have to invest over the course of my life still, I'd rather pick a few stocks that I think I'm very confident that they have a high growth potential, even though they may totally go south, but I can hold them long enough that they can recover, which is my strategy. So we've talked about this in other, like, I'm very bullish on Tesla. I think the odds of Tesla completely going bankrupt are very, very, very small. I think the stock will fluctuate wildly over the next 5 years, but I think at some point, if you look at the trajectories of like Amazon and Disney and all these very Facebook, etc., they start off very, very low. And then the first year or two, they start to creep up. And then once they hit their stride, they go up at a very, very, very fast pace. And Tesla, I'm sad I didn't invest sooner, but it's just hitting that stride, I think, where it's going to shoot up. So I do have my 401k plan, and that's where I'm diversified. But in my disposable money that I can afford to lose, I'm going all in.
Nice. And for the record,
and this is just my strategy.
And that, yeah, exactly. And at this part of my life, my strategy is very, very similar to yours. Like I'm taking on risk, outside risk to outsized risk to get outsized returns, right? And that's similar to, sounds like what you're doing is, yeah, we have our own like 401ks and we have our safe investments over there on that side. And then, somewhere else with the extra money we have, yes, we're taking some risks and being aggressive. But when you become like 55, 65 and you're looking at retirement, have you thought about how you're going to change up your portfolio?
If this plays out the way I want it to, and I have enough money where I don't really need dividends, or I don't need that 4% return, I just have enough money in the bank and it can it can depreciate with inflation. If I have enough money there, I'm going to be if I have what I need, I'm going to be very, very, very safe. If I do not have what I want or need, I'm going to be very aggressive with my investing. Because
even in your 60s, you're going to be taking some gambles.
If I don't have it, because here's the thing, if you have, say, $50,000, it's a lot of money, but it's not enough to really retire on. It's enough to just have it sit there, but you don't either you just burn through it buying stuff and then it's gone, or you just sit on it like an egg and then it doesn't do anything. It just sits there. So either way, it's not a useful use of that money. Because if you squander it, it's pointless because you've squandered it. If you don't really invest it aggressively, the 4% on that return it's not really changing the quality of your life. So why not be aggressive with it? Because you really have nothing to lose, because you can't do much. Okay, let's say, what do you do with it? You take a few really, really nice vacations. At least you'd have those experiences. But if you just put it in like a bond or like a super safe fund,
right,
it doesn't really change the quality of your life. So it doesn't gain anything.
Yeah, I guess you're right. Yeah, at that point, you have to ask yourself, yeah, like, why did you save all this money and what do you want to do with it? And you might as well enjoy life, right? You might as well try to get the most out of all the money you've saved over your life. And, yeah, I mean, I don't disagree with it. If you can handle the ups and downs, and if you have the stomach to do it, take that risk and hopefully it pays off.
Understanding that if you could invest it and then it may all go south, but you're still working anyway, but that doesn't change because you'd have to be working anyway. So it really doesn't make any difference.
Yeah.
So it has
And
almost only an upside.
you're right. Actually, you could look at it that way. Like when you're 60, or when someone's 60, they say, you know what? I could play it safe and retire at 65. I could take a gamble, and if it all goes well, I can retire at 65 with a lot of money. Or if it goes south, then you know what? I got to work for an extra like 3-4 years, and I'll retire at 69. And I mean, either way, you're going to be okay, right? If you have a half decent job, have decent income, you can take that gamble at 60. I guess you're right. Yeah. And you can take the same gamble at 55. You can take that gamble now and say, you know what? I'm going to take a gamble. And if it doesn't work out, I'll just have to work a few extra years and save up the money.
Kind of. The benefit, though, and you've said this before, is if you're investing in large companies that are not going to go bankrupt, like as long as it doesn't go bankrupt, it may fluctuate, and then at some point it will probably come back. So you have that benefit of time on your hand. But if you're 65, then you don't really have that benefit of time, because the stock may like drop and then it may just stay down longer than you want it to, then you don't see that benefit.
Right. Yeah, I agree.
So what's the takeaway from this podcast? What's your takeaway?
Takeaway: 10% of American retirees live in poverty. Don't be one of them. Start saving today.
Which is a lot of people.
That's a lot. 1 in 10.
That's a lot of people in poverty.
So, yeah, and I mean, that's just generally speaking, that's the poverty rate for working adults, or adults of working age as well. And so that kind of carries on. But roughly 1 in 10.
And when you say poverty, how do you define poverty?
You know what? I just pulled up some American statistic. It's however the American government defines poverty. That's a good question. You know.
Okay, you know what? I actually want to look that up. Because in the United States, the definition of poverty is an individual with less than $36 per day, or a family of 4 with less than $72 per day. So $36 per day. So what's 36 times 365? So that's $13,000 a year.
Wow. Okay. Wow. Yeah.
So 13,000 is poverty. And would you say the Social Security was 1,500?
That's the average Social
month?
Security check is 1,500 per month. Correct.
Times 12. So 18,000.
That's for one person. Yeah.
For one person.
Yeah. So I don't know how.
So
I don't know how. Like,
Social Security
yeah,
gives you a little bump, but then you're taxed on it. Don't forget, like you have to pay some tax on that.
Oh yeah.
Don't forget the tax.
That's right.
So Social Security gives you a touch above poverty, as the U.S. government defines it, which is an interesting way to think about it. So you've worked your entire life, so that way you're a touch above poverty at retirement.
And sadly, I mean, I think that's the whole point of Social Security, is to keep people out of poverty. Like that's why it wasn't invented to keep people, so you can drive your BMW to Starbucks and have your $5 latte. I mean, so right, Social Security was there so people are not like on the street begging, right? And so I guess that's what it does. But if somebody has the full 35 years of work history, and they've had, I think $140,000 a year is the maximum that Social Security considers, and they wait until the last day to retire, which is age 70, and that's when they start collecting their Social Security benefit. They could get up to, like, I think right now the maximum is $3,800 a month, just under $4,000 a month, which is pretty good. And then good thing with Social Security is supposed to be, I think it is, indexed to inflation, right? So they have COLA, cost of living allowance. So if they calculate inflation at whatever 2%, 3%, then they're going to up those Social Security checks to keep pace with inflation. So I think most Americans will collect around, I don't know the number, but I think between $500,000 and $1.5 million from Social Security throughout their life, right? From the time they start collecting to the time they pass away. It's a very significant part of income. I mean, it might even be like the major source of income for retirees in America. So,
well, it is, but it's still just a touch above poverty. So I don't know if you've ever gone to the grocery store and saw what you, like you're not getting organic eggs and milk. You're getting
correct. And so
cheese and crackers and tea. You're getting tea and toast.
Thank you. And thank you for bringing that up, because that's one of the things we started saying at the beginning of this of this show, of this episode, is that like a lot of Americans overestimate what they're going to get in retirement from Social Security. Like people think, oh, Social Security is going to be great. The government's going to shower me with all kinds of money. And it's like, in reality, like it's not a whole lot. It's not going to be enough for you. And so people need to save money. They need to invest money so that they have more than just Social Security, and it's going to last them well into their retirement. So yeah, start saving today. That's the number one takeaway. And the sooner you start looking at your retirement, the better. So I'm going to say it again. We'll put it in the show notes, ssa.gov. Go on there, see if you can estimate what your monthly Social Security benefit's going to be, and start planning from there. Is it enough? No, it's not enough. How much extra do you need? Where's that extra going to come from? And the sooner people start thinking about it, like everyone's going to be better off.
100% agree. On that note, Gabe, thank you. This was a fantastic podcast. Very
Chris,
informative.
great to talk to you as always, man. Thanks.